So we got a very important show today to talk about what you have to do if you own a small business. Some new requirements that you're going to have to make sure that you follow prior to year end. And then we thought it would be interesting to speculate a little bit more in greater detail about some of the tax changes that you can expect to see going forward. So to help me with that speculation, joined by none other than Kristin Castello. Good morning. How are you?
I'm good, Joel. How are you?
I am fantastic. We are here once again. Kristin's background, obviously, certified financial planner, certified financial fiduciary, and also a CPA on the team at Nelson Financial Planning. And yeah, we got a range of things we'll talk about this morning for our listening audience.
Yeah, should be pretty interesting.
So welcome into Dollars and Cents, where we help you make sense out of all of life's decisions involving your dollars. One of Central Florida's longest running radio programs, coming to you on a host of channels throughout the Central Florida region. Also a top 25 financial planning podcast. So make sure you check out our website, which is newly redesigned. So you can check out all of the new redesign that hopefully makes it easier for you to click on various links and find our channel on your favorite podcast platform, or even on YouTube as well, where you get to see us live in the video. And then, of course, my name is Joel Garris, certified financial planner as well, but not a CPA, ex-lawyer. So I'm recovering from that still 25 years after the fact. Also part of Nelson Financial Planning, where we help you improve your life with a successful and cost-effective financial plan. So it's Thanksgiving week, right? Kristin, you've got a kind of a unique Thanksgiving in front of you. What are you doing for Thanksgiving?
Yeah. So Thanksgiving is going to be a little different for us this year. We're actually going to be traveling to visit my mom's family in Chile.
Okay. All right. Well, then, and we were talking the other day. Obviously, they don't celebrate Thanksgiving in Chile.
No.
So you did it ahead of time.
Yes. So we had Thanksgiving with my in-laws and then also with my family last week. So we had early Thanksgiving this year.
Excellent. As for me, we've got the three boys are coming into town, so that's good. They start to arrive here in the next day or two, and I'll do turkey three ways. So we do it on the big green egg, and we fry one, and then we put one in the oven for those traditionalists, if you will. So we've got a bunch of people showing up. Certainly a fun time of year, that's for sure.
Mm-hmm. Yeah. We've actually kicked off our food and toy drive here at the office as well.
Right. That also helps too, seeing all the food and the toys and all of those kinds of things that really do help to kind of make the office a little bit more festive. And after Thanksgiving, I do like to sort of follow the traditional route of, we like to decorate the outside of our office, right, with lights and stuff like that. But we like to do that after Thanksgiving to give Thanksgiving its formal due. We've got Tom the turkey all blown up in front, where he will remain, and then he'll go away for another year, and we'll shift gears to put up some lights and things like that.
Yep. So it's getting pretty festive around here. It looks
That's good. Yeah.
Getting in the spirit.
Yeah, very good. So this past week, and also let's not forget, because I always have to feel like I have to explain it. The reason that we are a little bit, scruffier than normal, if you're looking at us on YouTube, is that every November for several years now here at the office, we've been engaging in No Shave November, which is a organization that is dedicated to raising awareness for men's health issues. And so the gentlemen in the office wind up kind of tossing the razors temporarily away. I'm told that I have to get rid of this before Thanksgiving. So your husband doesn't participate in any kind of No Shave November type of activities?
No, not this year at least.
Okay, all right. Well, you're going to be away for a few days in Chile. Maybe you can, take advantage of it. Well, that is great. So this past week, we also had our fourth quarter client educational event. As you know, if you're a listener to the program, or more importantly, if you're a client of Nelson Financial Planning, you know that we believe in the power of education, have a variety of events during the course of the year to help educate our clients, where we bring in senior strategists, portfolio managers, economists, things like that. This past week's program featured an economist that was named by CNN Money Magazine as one of the top-ranked equity research providers. So a very well-respected individual. He had some really interesting kind of key points, didn't he, Kristin?
Yeah, and a lot of them were very positive, too. So it looks like there's a positive horizon out there for us.
Yeah, one of the most interesting things, I think, which I hadn't really kind of thought a whole lot about, is that we are seeing a relatively unique environment from an interest rate perspective.
Mm-hmm. Yeah, so they were talking about how this is a very rare thing that they did an interest rate cut during an expansionary period in the economy.
Yeah, because usually you think about the Fed lowering rates and lowering rates in reaction to an economic contraction, right? So that's how it goes. There's economy shrinking, we lower rates to help reduce down the cost of borrowing, hoping that borrowing will help to sort of re-stimulate economic activity. But so this is truly kind of a rarity where you've got an economy, when you look at the data, that is sort of still in that expansionary mode, and you're still cutting rates. So pretty rare combination.
Mm-hmm. Yeah. And what they were saying is, in the past, when this has happened, the market does go up over time. So over the next couple of months.
Yeah, because it's also kind of hitting when the market is actually kind of hitting some high water marks and those kinds of things as well. So all of that winds up being a pretty interesting development. And when you look at it historically, there's been a little over a dozen other times where we've seen this kind of activity where economy is expanding and interest rates are getting cut, and ultimately average return over that subsequent 12-month period of time, right about 18%. So this is a pretty unique setup economically as we think about what the road ahead might look like.
Yeah, interesting times, that's for sure.
That always is, and it certainly will be as we start to get into our conversation about some of the tax changes that we might expect. We're going to talk a little bit about income tax rates. And what else are we going to kind of share with the listening audience?
Mm-hmm. Some changes to deductions as well as some credits that are out there.
Yeah, so all parts of your tax return potentially going to be very different than what it used to be, particularly with all of these tax rates and things like that are about to expire. So it is coming to, of course, the end of the year 2024, and small businesses. We've talked about this earlier in the year. Small businesses certainly don't appear to be getting any relief from yet sort of another regulatory requirement. So if you own a business, or and even if it's not necessarily an ongoing business, if you just have shares in a company, then there's some new requirements that you're going to have to make sure that you comply with before the end of the year. Isn't that right, Kristin?
Mm-hmm. Yes, and there are pretty steep penalties for not complying. So this is something that you really want to pay attention to if you own your own business.
So when we think about that, what is the core of this regulatory requirement that we're talking about here today?
Mm-hmm. So this is part of the Corporate Transparency Act. So this was passed in 2021, and it's going into effect by the end of the year. So what they're looking for individual owners to do is just to go and sort of put your information into the FinCEN regulatory website, just to give them some more information about who owns each company that's out there.
A lot of additional information that you're going to be required to report to the federal government, and you must do so. So we're going to have a lot more about this because it's new, and it's got to be complied with prior to the end of this year, 2024. So if you're one of the 33 million Americans that owns or has ownership in a particular business or an LLC or whatever the case may be, you really do want to stay tuned here on Dollars and Cents. So we'll be back after these messages here on Dollars and Cents with Joel Garris and Kristin Castello of Nelson Financial Planning. So we're talking about the new requirement that small businesses must do prior to the end of the year. And Kristin, this all has to do with the Corporate Transparency Act that actually passed a few years ago, and now it's just kind of sort of getting put into effect, if you will.
Yeah, and we were honestly hoping that they might delay putting this into effect, but we haven't heard anything about it being delayed, so it is something that you'll need to do by the end of the year.
So in terms of that, what do folks have to do in order to sort of comply with this Corporate Transparency Act?
So if you own a business, what you'll have to do is submit a beneficial ownership information report. So this is something that you can submit online. The website is just the fincin.gov/BOI website, and it's completely free to do. And what it is it's just looking to find the individual owners of the company. So you'll just need to submit some information about, so if you own a business, so it would just be your own personal information. So your name, address, you'll have to submit a picture of either your driver's license, passport, some sort of identifying document.
Yeah, so FinCEN is a short for the Financial Crimes Enforcement Network. It's a area or part of the U.S. Treasury that we are certainly very familiar with at the office. We actually have to check our database just about every couple of weeks because you get these lists from FinCEN about different criminals that are on watch lists, and you're required to sort of search your database and keep track of the fact that you searched your database. And obviously, if a name pops up, then you've got a reporting requirement, which is actually pretty extensive. Good news is we've never had anybody pop up here at the office, so that's good. But it's that same concept, right, Kristin, about what they're trying to get at and where these types of requirements or sort of new rules come from, right?
Exactly, yes. And they're also trying to look at companies that are in sort of company trees where it's an LLC that owns an LLC that owns another LLC that owns a trust that is owned by 3 different people.
Yeah, so really trying to sort of follow the money, if you will, and uncover where there may be layering to avoid taxes, and then of course any truly illicit or illegal terrorist type of activity as well. That's the premise behind that. But you, even if you're not involved in any of that, that's the point, is that you have to get online and fill out this registration. So what's sort of the deadlines that people have to observe on this one?
So there's a couple different deadlines depending on when you started your business. So if the business was started before 2024, so if you started it in 2023 and earlier, your deadline is the end of the year, so 12/31/24, so December 31st of this year. If you created your business during this year in 2024, then you have 90 days from the day you started your business to file the report. And then moving forward, you'll have 30 days to submit any changes to your personal information or to the business information, such as, if your name changes, your address changes, things like that. That timeline is about 30 days.
Yeah, and I guess going forward, if you establish a business after January 1, 2025 and going forward, then that 30-day requirement, that 30-day rule also applies then.
Yes.
So really something that you've got to really keep track of. And I guess that's one of the things that we do and why we do the program here on Dollars and Cents is because everything's sort of constantly changing, and we like to keep you as informed as possible on just things like this. This is a great example of where having good information helps you to make good decisions and potentially stay out of trouble. Hence the name of the program, Dollars and Cents, where we're helping you make sense out of all of those different decisions involving your dollars. My name, of course, is Joel Garris, certified financial planner, certified financial fiduciary at Nelson Financial Financial Planning. Joining me this week, Kristin Castello, also a certified financial planner and certified financial fiduciary at Nelson Financial Planning, where we got a team of great folks who also happen to be ready, willing, and able to help you improve your life with a cost-effective and successful financial plan. Make sure you check out our newly redesigned website at Nelson Financial Planning to learn more about us and maybe even take advantage of that free consultation that we always have available, along with our special offer right now during the holiday season, where you can get a free copy of our book, Next Gen Dollars and Cents. Talk about a great gift for a loved one to help give them some tools to achieve financial success, right?
Yeah, absolutely. Yes. Great stocking stuffer, too.
There you go. Very self-serving since I wrote it, but hey, that's okay. So, Kristin, you've had to deal with this beneficial ownership filing. What's it like? Share with us a little bit about kind of the process, if you will.
Mm-hmm. It was pretty easy. It took about 5 or 10 minutes. But I'm the only owner of my business, so it was just entering in my personal information.
You're also a little bit more sophisticated than sort of the average person out there being a CPA. But yes, but the process is all online. Yes. You just kind of walk it through, if you will.
Mm-hmm. So the first thing you'll enter in is your company information. So that will be the company name, the EIN if you have one, any trade names that you're using besides the legal company name, and then the address for the company. And then from there, you'll enter in the individual owners of that company. So that will be your personal information. You'll also have to enter in some identification numbers, such as a driver's license or a passport number, and you'll have to upload a picture of that document as well. That's
a lot of information.
It is a lot of information, and they kind of walk you through it, and then you just hit submit.
So one of the struggles and the frustrations that always happens, and I'm sure many in our listening audience have run into this, is that, when you say upload a picture, that sounds like that is, just like second nature. But for some of us who, are of a certain age where we did not grow up with a cell phone in our hand, that's not exactly second nature to be able to do that. So there's definitely a process here. So you really want to leave yourself enough time to be able to do that, because this is not sort of an annual requirement. It's sort of one and done. Mm-hmm. But the part that is ongoing is that you are required to keep that information as up to date as it possibly can be.
Right. And we mentioned it earlier. You only have 30 days to update the information if, your name changes, your address changes, things like that.
So can anybody dodge this thing? I mean, are there any ways to get out from underneath this?
There are some companies that are exempt. There's actually 23 categories of companies. Some include banks, credit unions, public accounting firms. But even those companies still have to go in, register their name and EIN, and then click the box that they're exempt.
So even if I am exempt, I still have an obligation to still at least go online and put in that basic information. So It's not like I can just get a free pass and ignore it. Mm-hmm. I still have to do it. And what's interesting is that I think a lot of people are probably out there right now thinking, well, I set up this, shell company, I set up this consulting company, or I set up this small business, maybe on eBay or whatever the case may be. And so I have a company, but there's not really a whole lot going on. It's just sort of sitting out there. So you may be thinking that it might be inactive, but even that you've got to be real careful with if it is sort of a less active or maybe even an inactive company.
Mm-hmm. Yeah, they say there's a 6-part test on if you have an inactive company on whether or not you have to file. So, just to be on the safe side, it might be better just to file the report.
So, Kristin, what's a great resource for people to sort of check into to kind of learn more about this, to make sure that they are doing it right?
So you can visit the finson.gov website. They'll have some resources there. Or if you really have a complicated situation, seek out some legal advice and kind of go from there.
And we also have written a white paper on this, so if folks want to reach out to us at the office, courtesy of our website at Nelson Financial Planning, and request a copy of that white paper. That's a white paper that we've shared with our clients to give them that perspective on it. Kristin, I got a particular view on this. I just think it's another regulatory requirement, another way to gather data. And I don't know that I trust my government with their data gathering.
Yeah, it's unfortunate, and it's unfortunate the penalties are so high too.
Well, and everybody says, oh, there's not a cost to it, but the reality is there is a cost. There's a cost of time,
Right.
and to the extent you hire a professional to help, well, then there's a cost associated with
Right.
it. So anyway, well, it's required, so you better do it. We're going to take a break and continue here on Dollars and Cents with Joel Garris and Kristin Castello of Nelson Financial Planning. So our next topic is going to be one that I suspect we will be talking more about in future episodes here of Dollars and Cents, because we expect there to be a wide variety of tax changes ahead with the new administration. And clearly, tax changes, right, Kristin? I mean, those are going to affect your finances, which is why our team at Nelson Financial Planning also has tax experts like Kristin as part of the overall team. So welcome on into Dollars and Cents, where we help you make sense out of all of life's decisions involving your dollars. You can catch our program on your favorite podcast platform as well, or if you like to watch podcasts on video, you can go to a place called YouTube. They have a bunch of videos there, including our channel, where you can check it out. You can see my feeble attempt at No Shave November, which is, I am told by my wife, needs to be gone by Thanksgiving. So we'll make sure to honor that, and we hope you have a great Thanksgiving week. Hard to believe Thanksgiving already right around the corner.
Yeah, this year has flown by.
It really, really has. So, Kristin, let's get started on this. We got all kinds of things to be talking about, but let's set the stage for why it becomes readily apparent that we're going to see perhaps a lot of tax changes for what's in the tax code, kind of thinking about things going forward.
Right. So back in 2017, 2018, President Trump passed the Tax Cuts and Jobs Act, which drastically changed the tax system. So it reduced tax rates, it limited a lot of deductions. The goal was to kind of streamline the tax return. So that is set to expire at the end of 2025. But then we have President-elect Trump with new tax proposals that could go into effect in 2026. So we're kind of in this middle area of, we know that the tax law changes that apply to 2025 are going to change for 2026, but then we have some new stuff on the horizon that could potentially come into play.
Yeah, a lot of different things. So we're going to try and cover, kind of the highlights here on the program, and obviously in future programs, as this stuff starts to get more defined, then we're going to be continuing to inform you on that. But let's also make sure that we set the stage. So when we talk about 2025 and tax changes for 2025, that's not really something you're going to see in a few months, right? In a few months, we're still 2024.
Right.
When we're filing that tax return, it's 2024. Unlikely that we'll see a host of tax changes on that relative to what was, say, on your 23 tax return.
Right.
Because that would require Congress to act, and it's probably not going to act in the lame duck session that it is currently sitting in. So a lot of what we're talking about now is 2025, which would be impacting the return that you would typically file in February, March, April of 26.
Yes.
Yeah. So just understand, folks, that a little bit of a lag in terms of the applicability. So if you're thinking, oh, well, I'm going to get a bunch of changes on the tax return that I'm going to file in the next couple of months, Unlikely. A lot of this is sort of more prospective. So, and the biggest of which is obviously individual tax rates, right? What's the expectation sort of on that front?
Yep. So for 2024 and 2025, we are still under the Tax Cuts and Jobs Act's reduction in tax rates. So those rates kind of range from 10 to 37%. So starting in 2026, those are set to increase to what they were prior to 2017. So that ranges from 10% up to 39.6%. So kind of just looking at what this would impact just a standard married couple that makes about $100,000. That would be an extra $2,500 of taxes that they'd pay under these higher rates that are set to come back in 2026.
Yeah, and usually it's if you kind of look at the old rates versus the rates that they're currently at, it's usually about a 2 or 3%. Like so, the 15%, what was the 15% is now 12. What was the 25 is now 22. So that would work out. I mean, where if you go back to the old rates, that $100,000 example you just gave, yeah, you're going to pay probably $2,000 or $3,000 more. Right. In taxes. Obviously, that's a big part of what candidate Trump was talking about on the trail in terms of some of the proposals.
Right. And he's also suggesting that we reduce those rates even more. So he wants 4 buckets that are 10, 15, 20, and 25%. So is that going to happen? It's very unsure at this time.
Yes, I think that we'll see some of the horse trading that sort of is going to come into effect. I think there is perhaps a takeaway, though, to think about as we think about what the implications might be on this, drawing the distinction between 24 versus 25. And what would that be, Kristin?
If you can, push some income into 2025. Yeah. So we know that the rates are going to increase in 2026 if there is no other legislation put out there. So if you're wanting to do things like Roth conversions or sort of save on taxes, see if you can kind of push some income into 2025 and lower your income in 2026.
Yeah, that certainly as you think about those individual tax rates, that's some good advice for folks. We'll shift gears. Corporate tax rates. What do you expect to happen there?
So the corporate tax rate reduced from 35% down to 21% back in 2018. So that was a permanent change. The corporate rate is not going to increase. But unfortunately for pass-through entities, the qualified business income deduction, it's a 20% deduction off of your pass-through income. That is set to expire at the end of 2025.
So that little QBI, as it's referred to in sort of accounting and tax language, that was how they were able to say to folks that didn't have bigger companies, if they had S corps or things like that, to ultimately give them the break on that lower corporate tax rate. But what's interesting is that one is actually set to expire. The other one isn't.
Right. It was meant to kind of level the playing field. But President-elect Trump is kind of wanting to make that permanent. So we'll see if that comes into fruition.
So that's some interesting stuff. So individual tax rates, corporate tax rates. I guess we'll hit Social Security, right? So Social Security all over the map in terms of how this one might play out.
Yeah. So it's been promised out there that Social Security won't have taxes on them anymore. But Social Security has such a weird, unusual taxing system.
It really does.
It'll be kind of difficult. But I think this is a huge deal for a lot of Americans that are really dependent on Social Security. Because, I mean, we've seen plenty of tax returns that if Social Security was not taxable, they wouldn't even have to file a tax return.
Right. And the rules really are convoluted. You know, different income levels trigger different amounts of your Social Security to be taxable. We see that for people that prepare their own taxes. That's probably one of the biggest areas of errors that people make is overpaying on the taxes on Social Security. And worse, those thresholds for determining taxation on Social Security never been indexed for inflation.
No, not since the 80s.
So that means that more and more people, to your point, more and more people, Kristin, are finding themselves having to pay tax on Social Security, even though their income hasn't necessarily shifted that dramatically. So those are the big three. I guess the other one that we would toss in there is that came up, which is one that hasn't necessarily been talked a whole lot about much prior to this sort of election season, and that is tip income. So what's the deal on that?
Yeah. So that is no income tax on tips or also on overtime as well. It's kind of interesting how they're going to get to this. So if they do end up implementing this, how would go about making tips tax free?
Yeah.
It could either be categorized as a gift. It could be a $20,000 tax free limit sort of thing. Or it could even be a deduction. So you would report the tips and then just do an offsetting deduction.
All interesting concepts, particularly kind of the gift one. One of the other strategies they've used in the past, which I think also has some value, is that for a couple of years there, right, post COVID, they were allowing for 100% deduction of business meals.
Mm-hmm.
That's back down to the old rule at 50% now.
Yes.
Yeah. So much to talk about on that. We're going to take a break though, and when we come back, we're going to talk a little bit about deductions and some of the things that we might see changing there, tax credits as well, and then estate taxes. So we got much to talk about in the last segment of this week's episode of Dollars and Cents. So stay tuned with us. This is Joel Garris and Kristin Castello of Nelson Financial Planning. So with Thanksgiving coming up, we thought it only appropriate to stuff the show with a lot of information that you can use. We've also got a lot of topics where we've got some future second helpings of these topics that I think we're going to circle back around to in the weeks and months ahead, particularly, Kristin, with what we're talking about right now, which is some of the expected tax changes. So let's set the stage, if you will, for what we've talked about so far and what we're about ready to discuss.
Mm-hmm. Yeah, so we're talking about kind of the rules that are still going to be in place during 2025 and when you file your 2024 tax return this spring. And then we're also talking about what's on the horizon for 2026.
Yeah, so a lot of this is going to be very prospective because 2024, the return that you'll be filing, everybody will be filing here in a few months, probably not going to see a whole lot of change from what you saw in 2023.
Right.
Okay, I think that's, I don't think Congress is going to pass a big tax bill between now and, and the end of the year. So much of this is going to impact kind of what the picture is in the year 2025. And to your point, in 2026 as well, which is sort of the year where a lot of these tax cuts from 2017 are set to expire. So a lot of interesting things to sort of chat through. We've talked about individual tax rates, corporate tax rates. We've talked about Social Security taxation and then tips. Now we're going to shift gears in this segment to talk a little bit about the deduction. So let's make sure that folks understand, Kristin, the deduction parts are sort of which part on my tax return?
Yes, so you can either take the standard deduction or you can itemize your deductions. So a lot of these that we're going to be talking about are if you can itemize your deductions.
And one of the things that was done with those tax changes back in 2017, again, the notion of simplification, right?
Mm-hmm.
So to simplify the return, a standard deduction is a set number, right? You take it and you use it and you don't have anything more to do versus itemized deductions, which requires you to itemize a bunch of different things.
Mm-hmm.
And so you sort of get your pick of which is the bigger number. But because the standard deduction jumped up so much, the vast majority of people, just 90%, just using the standard deduction.
Right. Yeah, that is exactly what we see during tax filing time.
So, but now if you start to see some changes to some of these itemized deductions, it may open up the opportunity for folks to do better by itemizing, because those totals of those itemized deductions may be a bigger number than the standard deduction. Chief among them is this first thing that you're going to talk about.
Right. So the state and local tax deduction. So with this deduction, it's been limited to $10,000 for the past couple of years under the Tax Cuts and Jobs Act. So this really impacts those living in states with income taxes and high property taxes. So the way that the deduction works is you're able to include your state and local income taxes and then add on your property taxes and take a deduction for that. But that's been limited to $10,000 for the past couple of years. So starting in 2026, that $10,000 cap is going to expire. So that means that people that live in states like New York, New Jersey, California, they'll have the ability to write off all of their taxes moving forward.
Yeah, and so that definitely changes because that $10,000 limit certainly impacted particularly residents of those higher income, higher real estate tax jurisdictions. So that's one part. With the standard deduction back in the day, you used to be able to have a personal exemption. Personal exemptions were eliminated once they went to the higher standard deduction. What does the future on that part sort of look like at this point?
Yeah, that's set to come back as well. So that exemption is $4,050 per individual on the tax return or qualifying dependent.
So ultimately, though, if the pathway is that higher standard deduction, maybe you see the personal exemption come back, but if you're going for the higher standard deduction, at least from a tax policy perspective, might not see those personal exemptions come back.
Right. Yes.
So then, what about some of the other miscellaneous deductions? There was a bunch of them. There used to be a bunch of them. Most of them got eliminated, so that also would be part of the conversation, right?
Mm-hmm. So again, to try to streamline the tax process, a lot of these deductions were just eliminated or kind of limited on what you could deduct. So coming back in 2026 would be the investment advisory fees, legal fees, and unreimbursed employee expenses, amongst some others. So the big one, I think, will be the unreimbursed employee expenses. Yeah. I mean, starting during COVID times, a lot more people work remotely. So that would be something that they could take advantage of if this does come back in 2026.
Well, and one of the other ones, particularly here in Florida, is the casualty loss, right? So if that comes back, then you would at least be able to write off losses that come from hurricanes and floodings and whatnot. So that's kind of the landscape, if you will, on the deduction side. A couple of big tax credits that were certainly talked a lot about as well. What do we think might be the sort of the impact or the changes there?
So the premium tax credit, I think, is one of the biggest ones. So this is a refundable credit that helps those that are on the marketplace insurance or the Obamacare insurance, and it helps them cover their premiums on a monthly basis. So what kind of happens is you get a credit or an offsetting towards your premiums, and then on your tax return, you sort of true it up. Yeah. And if there was a discrepancy, then you either get a refund or you might owe some additional taxes for it. So that is set to expire after 2025. And that is going to impact millions that are on the marketplace insurance.
And this really is probably one of the bigger black boxes in terms of how that might play out. Certainly, the exchange provides health insurance to many Americans who do not have it through their employer or cannot obtain it otherwise. The catch was always how the credit worked, right? Because we've seen many people over the years sort of get tripped up on it, right? I mean, yes. The advancement of that credit always winds up being a little tricky.
Yes, it's really dependent on your income. So if you kind of go $1 over the income threshold, it could trigger a huge tax bill.
Yeah, and that's the thing is, you apply for your health insurance, you go through the open enrollment, and you take a stab at what your income is going to be for the year. That then determines the credit. But if that's a wrong stab, then you're going to have some or a lot of that credit recaptured very, very quickly.
Mm-hmm. Yes.
And then the other one that obviously generated a lot of conversation out there on the campaign trail on both sides of the aisle, child tax credits, right?
The child tax credit, yes. So starting in 2026, if this reverts back to the prior rules, the credit's going to reduce from $2,000 per child down to $1,000 per child, and the income limits are going to drastically decrease. So it's going to decrease from $400,000 for a married couple down to $110,000 for a married couple. So
huge.
That's
huge. Much less people would then wind up getting these child tax credits. And if anything, on the campaign trail, everybody was sort of saying the opposite, where they wanted to increase these credits quite a bit over where they currently are.
Mm-hmm. I heard them throwing out increasing it to $5,000 per child. So we'll see.
Pretty significant. So much to cover on those tax credits. And then lastly, estate tax. That certainly is another part of the tax landscape.
Yeah, so right now the exemption is $13.61 million per person. So a married couple, that's over $27 million. That is set to go back down to the pre-2017 rates, which were $6.8 million or $13.6 million for a married couple. It's a pretty big big decrease.
Correct. And so as we kind of wrap up and sort of summarize all of all of this, Kristin, what are some of the key takeaways that you would say to our listening audience of these are sort of the concepts that you want to be thinking about going forward?
Yeah. So if you're going to make gifts from your estate, 2025 and 2024, the rest of this year, are good years to do that because we know that the exemptions are set to go down. Also, income, if you're looking to kind of push income into 2025 and 2024, just to avoid kind of income in 2026 when we know that the rates are going to go up.
And then obviously another good strategy is to bunch those deductions as well.
Right.
I mean, that also is always a good strategy. So those are just some things to be thinking about. Maybe around the Thanksgiving table, you can engage in a tax conversation. Probably don't want to do that. You might want to stick away, stay clear of that. But anyway, we will have much more on all of these topics as the details start to flesh themselves out. Thank you for listening to Dollars and Cents, and we hope you have a wonderful Thanksgiving holiday. Enjoy the time, hopefully, with family and friends. With that, this has been Joel Garris and Kristin Castello of Nelson Financial Planning here on Dollars and Cents.